While the Bank of Canada increased its interest rate again at the end of October, that increase was less than many had anticipated. Is this signaling the end of the increases? When the September inflation numbers came out a few weeks before the October rate announcement, economists at the major banks all increased their expectation for the October 26th interest rate announcement to be higher. Until then, the general consensus was that it would be a 0.5% increase. But once that inflation data came out, some were thinking that it might be as high as a full percent. Thankfully, that didn't happen, and the rate increase remained at the 0.5% previously anticipated. As a result of this lower than expected increase, we immediately saw new fixed rate mortgage offerings drop by about 0.25% at several lenders. Now, I've been getting a lot of calls, emails, and text messages from concerned buyers and homeowners alike about these increases. No surprise, right? A common question for current variable rate mortgage holders is, should I lock in now? Some of you took a variable rate mortgage when rates were down around 1.5%, and you've seen your rates increase all the way to about 5% now. That hurts, and it means a payment increase of over 50% from when it started. So this leads to the big three questions right now. 1, should I take a fixed rate? 2, are we actually seeing the end of this madness? And 3, is it smart to buy now as things are beginning to turn around? Where the rate game gets difficult is that by the time that we're looking to convert from a variable rate to a fixed rate, it's almost always already too late and involves accepting an even higher rate than where we would currently be on our variable. And it's because, as you can see on the chart here, the fixed rates tend to increase in anticipation of variable rate increases. So what we don't know is how much higher the variable rates are going to go. So that's what makes that decision difficult. For taking a fixed rate today, it really does depend on how much further rates are going to go up. Most models suggest that the variable rate will cost less over the next 5 years than the fixed rate. If we put you into a variable rate today that has stable payments, that can give you a buffer against a payment shock while still providing the probable savings that a variable rate will provide that a variable rate will provide in the back half of your mortgage term. So while I don't have a functioning crystal ball and I can't actually predict the future, I can tell you that the Bank of Canada is softening its stance on further rate increases. Yes, there will be more, but perhaps or hopefully not too many more. It's starting to look like there'll be much smaller increases going forward and hopefully not more than 1 or 2 more. For example, as of today, TD is still predicting only another 0.25% from before the peak, but they do admit that it could be as much as maybe 0.75% when they update their outlook. Only a few weeks ago, CMHC shared their forecast with me, and it shows the same upper end as what TD is stating, and suggests that rates will moderate over 2023, and then in 2024 we'll start to see them come down and maybe settle around about 0.75% higher than they were in the period pre-COVID. And that would put variable rates and fixed rates both somewhere around 3.5% when this is all done. So apart from inflation, the rising interest rates have already accomplished a lot of what they were intended to do. In Canada's largest markets of Toronto and Vancouver, thankfully we don't live there, home sales are down 49% and 46%. That's not prices, that's the number of sales, okay? Those were both overly hot markets and both were leaving the majority of homeowners out of the real estate market. Now, we didn't see the same kind of increase in Alberta, and we're not seeing the same kind of decrease in Alberta. October sales in Calgary were down 15% from last year, or about 2.3% from the previous month. In Edmonton, the most recent data I could get was September, but it saw a similar 15% drop year over year. Now to compare current information against those crazy few months earlier in the year that we saw. Edmonton saw sales peak in March 2022 at 3,267 total sales, and by September, the number of sales was down to 1,581. So that's about half. And it is different than previous years where the September versus March sales were typically within about 25% of each other. Average residential sale price peaked in Edmonton in April of this year at $416,000 and is now down to $375,000 in September, representing about a 10% decline in those 5 months. However, the last 2 months, the prices and sales number were much flatter, suggesting that decrease is largely done. Now, Calgary saw sales peak at 4,091 back in March, and by October it was down to 1,857, which is actually even more than half, but only slightly less than the same month from a year ago. And we weren't complaining about sales activity in October of 2021. Average residential sale price in Calgary peaked in February at $547,000, and it dropped to under $500,000 over the summer months, July, August, and September, and then increased in October up to $509,000. A big part of that was a shift in what was being purchased. Some of the lower end multifamily homes in Calgary are being selected over the single family homes. Now, in both major Alberta markets, we are seeing signs of prices stabilizing from the peaks, and we are still above where we were a year ago. We're seeing sales volume stabilize as well, and the current sales volumes are pretty typical, actually. The good news is that you can now take your time buying a home and not worry too much about being outbid, something that, at least in Calgary, was very, very common earlier in the year. Last week, Bank of Canada Governor Tiff Macklem met with the Senate Committee on Banking, Commerce and the Economy. He said, "This tightening or rate increase phase will draw to a close. We're getting closer, but we're not yet there." While the economy is still overheated, Macklem said that interest rate hikes to date are starting to have a moderating impact on growth. We see that most in the sectors of the economy that are most sensitive to interest rate hikes, like housing and spending on big ticket items such as vehicles. The effects of these higher interest rates do take time to spread more broadly through the economy. Unfortunately, there's not an easy button to restore price stability and stop inflation or to rebalance demand and supply. According to the bank's latest forecast unveiled in the October Monetary Policy Report, the bank expects headline inflation to average 6.9% in 2022, drop down to 4.1% in 2023, and settle back down at about 2.2% in 2024. Now, all of these numbers are lower than those few year-over-year monthly numbers that keep showing up in the media and, of course, that we're experiencing in the grocery stores. The bank expects a slowdown in economic growth in the coming quarters, with GDP growth stalling or being close to zero over the coming quarters. It might even dip below that, putting us into a technical recession. But annualized, the bank does expect growth this year to be at 3.3% for the year as a whole, to drop down to just under 1% at 0.9 in 2023, and then pick back up to the desired 2% in 2024. It is a tricky line to balance, and if they don't do enough, then inflation will continue to be too high and outpace the wage increases. That will force even higher interest rates to combat and likely a severe recession. Nobody wants that. On the flip side, if they do too much, they're going to slow down the economy more than needed, which also has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. Things are difficult right now, especially for those of us with higher debt loads or for those with variable interest rate mortgages that were under 2% only a few months ago. But there is light at the end of the tunnel, and we should see rates peak in the coming months. The rate announcement on December 7th will hopefully be only 0.25%, and if the stars align, it might be the final increase, although probably we'll see one in January or February of 2023. So, to summarize, the Bank of Canada tells us that the interest rate increases are nearly over. We can cheer for that. 2, we can reasonably expect inflation to calm down over the coming year. We can cheer for that. And we could start seeing interest rate decreases in about a year, Q4 of 2023 or early 2024. So, if you have equity in your home, but you need access to some money to help through this difficult time, we should talk. Reply to the email, message us. We may have some short-term liquidity options for you. If you're considering purchasing a home in the next year or so, we should talk so we can see if we can get you in before prices start to increase again. And if you have an upcoming mortgage renewal, we should also talk because you're going to see some higher interest rates than you're coming out of. So let's talk strategy as more data comes out to take advantage of the slower real estate market, but also position yourself to take advantage of rate decreases that we expect to see in the coming year or two. My team and I, we're really looking forward to hearing from you. Please reach out and we can definitely help you get through this. Thank you.